When you say the bloodbath has only begun, how much worse compared to last year?
Well, if we're going to have this year a hard landing, and I still expect a hard landing, because the Fed will have to keep on raising rates in spite of what happened with SVP to fight inflation, then we're going to have a recession. That recession is going to cause more defaults, because as income fall, people who have too much debt are going to default. And then the increase in bond yields and credit spreads is going to cause a recession is more severe. So there'll be a negative feedback between the real economy and the financial markets, with an economic crash leading to a greater financial crash, and a greater financial crash making the economic downturn more severe. Last year, even without a recession, just raising interest rates pushed the S&P 500 down 15%, Nasdaq 30%, and more risky assets down 50%. I would say even in a mild recession, the S&P 500 has to have a fall cumulatively of at least 30%. We're barely at 15 or less than that. And if the recession is going to be more severe, like during the global financial crisis, you could have a fall in equities of 50%. Maybe it's not going to be as bad as the GFC, but it's not going to be a plain vanilla recession. So something between 30 and 50, 40% cumulative. So we're still 25% to go. The argument for gold was based on rising inflation, the debasement of fiat currencies, central banks wimping out, also de-dollarization, because the strategic rivals of the US, whether it's China, Russia, North Korea, Iran, and others, they have a lot of dollar reserves. They have to move away from dollar reserves, because eventually, in a situation of a conflict, the US is going to seize those assets, like they did in Russia. And it's not just dollar, even the euro, the yen, or the pound, like in the case of Russia, could be seized. So the only international store of value that cannot be seized by the US and the West, if there is a conflict, is going to be gold. Of course, gold not in the vault of the New York Fed or the Bank of England or London, but gold in the vault of some institution in Beijing or Moscow. So those are also trends that are going to lead to gold prices rising, with central banks of rivals and even friends of the US who are worried about either inflation or secondary sanction. So that will lead the gold prices overall to go higher. When they're going to reach 3,000 and over which horizon to be seen, I don't want to be specific about it. I would say gold has upside, of course, in this situation rather than downside. Well, the central banks of countries that are strategic rivals of the US are going to gold because they're increasingly worried that those dollar assets and reserves are going to be seized by the US. There's a saying, if I owe you $1 billion, is my problem. If I owe you $1 trillion, is your problem. And the Chinese hold at least $1 trillion of US treasuries. And as the conflict in the US and China on Taiwan and so on could escalate from a Cold War to a hot war, the Chinese have to figure out how to diversify away from dollar assets, the same way in which the Russians had to diversify away from dollar assets. So one of the solutions, of course, is going into gold. The dollar has been overvalued, both on a fundamental basis, large fiscal deficits and large current account deficits. Japan and Europe have a fiscal deficit, but they have a current account surplus. What was propping the dollar last year was the tightening by the Fed. Now, if you believe that the Fed is going to wimp out, as I believe so, because we're in a debt trap, and what has happened with SVP is an example of how, when you have too much debt and there is a systemic financial risk, the central bank is going to wimp out. Then if the Fed is going to pause, that means lower short rates like happened today, and lower dollar, higher gold. Therefore, the movement downward of the dollar will have to accelerate, and that's going to increase the dollar price of commodities, starting with precious metals. So the dollar has to fundamentally weaken from here on. You have twin fiscal and current account deficits, you have de-dollarization, you have strategic rivals getting out of dollar assets, and now you have effectively the Fed having to be on hold, if not cut rates, and they're doing already backdoor QE with the backstop of the deposits of the banks. We are definitely in a geopolitical depression. There is a hot war with the brutal invasion of Ukraine by Russia. That war is going to get uglier with the spring, of course. In the winter, the two armies were semi-frozen, but now the conflict is going to get much more nasty. through the end of the year. In the case of the Middle East, Iran effectively is a threshold nuclear state, and that's an existential threat to Israel. And therefore, regardless of this rapprochement between Saudi and Iran, Israel is getting ready to potentially strike Iran this year. If that were to happen, of course, it would be a massive shock to oil and energy prices, because the flow of oil from the Gulf is going to be somehow curtailed while the conflict occurs. And the Cold War between US and China is becoming colder by the day, and I think it's only a matter of time, how many years before eventually there'll be a real confrontation on the issue of Taiwan. So we live in this geopolitical depression. The implication is that, commodity prices are going to be higher. If Russia-Ukraine becomes worse, whether it's oil and energy, whether it's food and fertilizers, whether it's other industrial metals, like it happened last year, there'll be a spike. If there'll be a conflict in the Middle East, of course, there'll be a curtailment in the flow of oil and gas from the Middle East, and the same thing in Asia. So we're living in a world in which probably commodity prices are going to be much higher because of geopolitics. If your money is below $250,000, is guaranteed by the FDIC is safe. If you have more than that, and you are in a large systemically important bank like Citi, JP Morgan, Bank of America, or similar, you'll be safe because those banks cannot be allowed to be collapsing. But if you're in a smaller regional bank, as we've seen, runs can occur, especially when the asset side of some of these banks is shaky because of exposure either to crypto or long-term treasuries or a very narrow deposit base that can be fleeing at any moment. So you're better off taking your money out. You can put it into a bigger bank. That's one option. You can put it in some safe short-term treasury mutual funds. That's going to be safe. Of course, you can put it into gold, but gold has some price risk. I think gold prices are going to go higher, but there is certainly more volatility in gold. If you want something where you preserve capital, I would say put it into a short-term treasury mutual fund. You get, almost 5% today on a short-term treasury. That's pretty good. Well, you have to realize we live in a world in which there are major economic, financial, monetary, political, geopolitical, and technological risks. So traditional investments like 60-40 or variants of it don't work. You have to think about how you protect your wealth in a world in which inflation is going to be higher. As I pointed out, short-term treasury, tips, gold, precious metals, probably even some of the green metals, and sustainable forms of real estate have been historically the assets that provide you a hedge against this type of volatility. And of course, there is a massive technological disruption. AI, machine learning, robotic, automation, quantum computing, and so on are going to completely disrupt not only traditional industries, but they can also disrupt some of the big tech companies. Right now, Google feels the threat coming from, say, OpenAI, and how a chat box like a ChatGPT could even replace a traditional search engine. So there'll be massive technological disruptions. Even blue chip firms that are in NASDAQ or in S&P may be disrupted, and so on. Of course, the average investor doesn't have access to the kind of VC investments in some of these firms. Many of them are not yet publicly listed, but there are ways in which you can indirectly expose yourself. If you buy Microsoft, you have exposure to, say, OpenAI and things of that sort. So you have to think really that we live in a world of unexpected, unusual, and unprecedented uncertainty, and everything is going to be disrupted. Jobs are going to be disrupted, investment are going to be disrupted, firms are going to be disrupted, technologies, entire firms and countries, and therefore you have to think holistically where you put your money. If we're going to have a war with China, China is going to become uninvestable, and therefore you have to stay away from China. I mean, a firm like Tesla, they're delusional, believing that they can stay in China. They have to get out of there, like most US firms will have to get out of there, because it will be on a collision course. So you have to think about where you invest your money, domestically and globally. in which sectors, in which industries, in which countries. There'll be massive disruptions in the next decade.